Welcome to the Valuation Masterclass Bootcamp final presentation. This is a time that students who have completed the bootcamp get a chance to share the work that they've done. Today's presentation is going to be on the company Target Corporation, and it's a lot going on there, and I think you'll find this valuation and the arguments that Wakas is making very compelling. If you want to build a competitive advantage in company valuation, just join us at Valuation Masterclass Bootcamp. In fact, here you can see if you act now, you'll get a $900 discount that lasts for 7 days only. Use the QR code or the link and that coupon code BC21 Live. Remember, you get 7 days money back guarantee. You don't like it? We don't want your money. Let me bring in Wakas. Hold on. All right. So, you ready to go?
Yes, I am.
You've worked so hard, I know, and I've watched you develop, over the last 6 weeks, and I think you got, a lot of good skills that you've been developing. So I'm really looking forward to seeing your work. And I haven't seen this complete presentation, so your final one. So I'm looking forward to that. So what I've done is I've just brought it up on the screen. And so before I go out, I just want to mention for the listeners and viewers out there, feel free to ask questions in the chat, and I will ask those questions of Wakas when we get to that point. So without further ado, I'm going to take myself out of the screen and then let you take over. You ready?
Yep, I am.
Okay, I'm going to take myself out now so you can start now.
Thank you, Andrew. Hello, everyone. Today, I am excited to present my coverage on Target Corporation with a buy recommendation and a price target of $140, which represents an upside of 46%. I reached the conclusion of this target price based on a discounted cash flow to firm valuation model using a weighted average cost of capital of 11% and a 1% terminal growth rate. Key drivers for my upside forecast include three main factors. First, Target is building new stores and remodeling existing ones to reach more guests. Second, Target is to improve its digital infrastructure to increase digital. Third, Target is significantly undervalued due to a decline in its reputation, and this undervaluation is expected to fade away. While there are risks, for example, momentum is against the stock, new reputational risk may arise. However, I believe the current undervaluation will correct itself. As of 2025, Target Corporation operates 1,981 departmental stores across all 50 states in the United States. Target's market share in the departmental stores industry is estimated to be around 43%. 75% of the US population lives within 10 miles of a Target store. Target aims to provide a pleasant, joyful, and affordable shopping experience for its guests, and it has more than 50 owned. Now, I would like to highlight Target's impressive growth strategy by expanding its reach to more guests. During fiscal year 2025, the company opened 23 new stores and plans to add 20 more during fiscal year 2026. Target's unique approach, featuring over 50 privately owned brands as part of its differentiation strategy, catering to evolving consumer demands. These owned brands contribute 1/3 of the company's revenue with higher margins. Target aims to sell more of its owned brands products by opening more stores. This differentiation strategy has generated $30 billion in annual revenue over the 5 years. Looking ahead, Target aims to achieve an additional $15 billion in revenue by 2030, while improving its profit margin from 26% to 27%. Additionally, Target is expanding its digital business. The company has developed a first-party digital business valued at $20 billion and achieved an 8% year-over-year growth in digital sales during fiscal year 2025. Notably, same-day delivery and drive-up services saw double-digit growth, a trend I expect to continue in fiscal year 2026 and beyond. Additionally, Target's third-party digital platform Target Plus has expanded to over 1,500 partners with a 20% increase in gross merchandise value to 1 billion in fiscal year 2025. Meanwhile, it continues to attract new partners with ambitious plan to reach a gross merchandise value of 5 billion by 2030, which I believe Target is well positioned to achieve this. Target has experienced a decline in sales and stock price over the past 2 years, primarily due to a temporary reputation dip resulting from its stance on Pride Month in 2023. Currently, its price to earnings ratio stands at 10.5 times, the lowest in a decade and significantly below the industry average of 26 times, as well as its own 5-year average of 19 times. Additionally, a low price to book ratio of 2.9 times indicates significant undervaluation. According to Forbes corporate reputation score, Target's reputation is rebounding. Therefore, I expect Target's price to earnings ratio to recover to 17 to 19 times. I want to highlight the resilience of the consumer staples sector amid economic uncertainty. Despite a revised GDP forecast from the IMF, this segment is expected to thrive and is projected to grow from 7 trillion in 2024 to 8 trillion by 2030. Key players such as Walmart and scale. Digital transformation and easing inflation are enhancing efficiency, with e-commerce expanding rapidly. Moreover, suburban growth is pushing demand even as private label preferences rise. This sector's fundamentals show that it remains a defensive stronghold in challenging times. Now, looking at the quarterly data, including quarter one of the fiscal year 26, revenue dropped by 3% year over year, primarily due to slowing consumer demand amidst cost of living pressures. The company also experienced a 6% year over year decrease in gross margin alongside a 10% increase in net margin. The decline in gross margin was attributed to higher sales costs that could not be passed to consumers. In contrast, the increase in net margin resulted from improved selling, general, and administrative expenses. Over 69% of analysts maintain a neutral stance on Target, with 10 recommending a buy. The consensus target price suggests a 9.4% upside. Additionally, consensus forecasts a 2% decline in revenue for fiscal year 2026. Although revenue is anticipated to decline, analysts expect gross profit margin to rise to 28% in 2026 from 25.8%, despite a slight dip in net margin. Here, I would like to highlight Target's revenue sources. The company operates 1,978 stores across all states in the United States, generating over 106 billion in revenue for fiscal. Target generates more gross profit in 6 categories of products, as shown in the pie chart. A significant portion of this revenue comes from food and beverages, which alone contribute 23% to total revenue. Other categories, including household essentials and beauty, are substantial contributors. During fiscal year 2025, digital sales accounted for over 20%, representing an 8% year-over-year increase. This growth is supported by Target's investment in digital expansion and initiatives such as same-day delivery and Drive Up. According to A-Stode's investment research FVMR investing framework, it indicates that Target appears attractive relative to 1,290 non-financial companies in the US among fundamentals, ranking it in the top 10% for fundamentals, characterized by a strong operating margin and asset turnover. Additionally, the valuation multiples such as price to sales, price to earnings, price to book indicates significant undervaluation. A-Store's investment research world-class benchmark ranking among 950 consumer discretionary companies globally shows that Target has consistently demonstrated strong asset efficiency, which helps it maintain its third rank in profitability. Whereas revenue growth has declined from the first rank in 2021 to the eighth rank in recent years. This is it dropped to number 6. Okay, the only thing I would like to point out in the cash flow statement forecast is that the capex during fiscal year 2025 dropped significantly, and based on management guidance and my analysis, it will return to near historical levels from fiscal year 2026 and will slightly rise each discrete year forecast. Thereafter, sorry. The current ratio is low, and I forecast it to remain at lower levels, indicating a short-term liquidity risk. However, Target has yearly renewable overdrafts sufficient to cover any shortages in its short-term liquidity needs. According to my forecast, revenue is expected to decline by 1% in fiscal year 2026 due to slowing consumer demand, and then grow by 2.5% in fiscal year 2027. DuPont's analysis, based on my forecast, the return on equity is expected to decline from 29.1% in fiscal year 2025 to 26.3% in fiscal year 2028, primarily due to an increase in equity levels resulting from retained earnings. The NOPAT and cash NOPAT are both expected to increase by 38% and 28% respectively from fiscal year 2025 to fiscal year 2030, while CapEx is expected to return to historical levels after declining in fiscal year 2025. Free cash flow to firm is expected to grow by over 8% in fiscal year 2030 compared to fiscal year 2025, after initially dropping in fiscal year 2025. So Target's valuation in comparison to the consumer discretionary sector for 2026 and 2027 presents a compelling investment opportunity, with price to book values at low levels compared to the USA, Asia excluding Japan, and global consumer discretionary sector. In addition, the higher expected return on equity of 22% and 24.4% in the 2026 and 2027 fiscal years, respectively, is also promising. Along with low price to book, Target's price to earnings also indicates significant undervaluation compared to the USA, Asia, excluding Japan, and global consumer discretionary sector, suggesting substantial upside potential. It is currently trading at a forward price to earning multiple of for 2027 of 10.4. So my valuation analysis for Target using a risk-free rate of 3.5% and market equity risk premium of 10%, I've calculated a cost of equity of 14.5% based on beta of 1.1. I assumed a capital structure of approximately 30% of debt and 70% of equity, which aligns with the current capital structure. I forecast a weighted average cost of capital WACC of 11% and a low terminal growth rate of 1%. My base case scenario values Target at $140 per share, indicating a 46% upside. In my sensitivity analysis, the optimistic case values it at $162, while the pessimistic case values it at $118 by adjusting the gross margin from 26.4%, 2% up and 2% down, respectively. Finally, I have identified several risks the Target may face, which could prevent my forecast target price from being realized, or it may take longer than expected to reach the forecast price. Even though the stock is currently undervalued, it may take longer to reach my target price of $140 per share due to a potential economic slowdown. Secondly, reputational damage, such as that Target faced during Pride Month 2023, could significantly impact sales and in turn the stock prices. Based on my analysis and forecasts I just presented, I recommend a buy rating for Target Corporation stock with a target price of $140, representing a potential upside of 46%. That's all from me. If you have any questions, I'm happy to answer.
Great. So leave that up. I want to go to the first question. Let's do it related to the valuation. Momin's asking about your weighted average cost of capital. Maybe you can go to that slide.
Yep.
Okay. Yep, right there.
Mhm.
So Momin says, so even with a high weighted average cost of capital, you still get over a 40% upside. Tell us more about that.
That shows the Target stock is like really depressed recently because the revenue and all those forecasts are like in line. There's nothing like superficial in them. But still the value comes up at 140, which shows like it is significantly depressed.
So, the valuation on a PE and price to book basis, as well as free cash flow basis, looks attractive.
That's correct. Yeah.
So let's go to another question from Momin, which was asking about what's the catalyst for the rebound. The share price has been beaten up. Basically, Target's made enemies of both sides of the Pride thing. It's like they've just done the worst. So now everybody's upset. Why? What would be a catalyst, or why would we want to buy it now?
So there are a few things. So one, obviously, as Forbes rating suggests, like that dip in repetition is recovering. So it's already not exactly at the level where it was, but it is recovering towards that point. So once repetition improves, like that is going to be positive for Target stock. Plus the remodeling and like new campaigns they started, that's helping also like to reach out to more consumers.
Okay, and Kanchapon says your valuation and revenue growth estimates are higher than consensus. What key assumptions or factors support your more optimistic view?
It's on management guidance and also based on my own analysis of like the over the years, like how much they can achieve.
Yep. So
yes, sorry, go.
We have some questions about the U.S. and China from Ashish and also from Tita and some other ones too. So there's another one here. So maybe you can just discuss where are things at right now with the China-U.S. trade and tariff situation, and how, as Tita says, do you think that 40% upside is a little too much when there's a lot of uncertainty around that, or what are your thoughts on that?
So Target used to source like about 60% of their products. I think it was 2017 or 16, but now they have already reduced it to 25%. So they're only sourcing like 25% of their products they sell from China, and they are diversifying away these products as well. So Target like started diversifying that when during the previous Trump administration, like when they thought like there could be issues like if they stick to one country, sourcing all the products from one country or most of the products from one country, then that could be a risk. So they started diversifying that from that point onwards.
Okay, can you go up to the P&L forecast?
Yep.
Yeah, there. Okay. All right, that's good. All right, I'm going to stop you. I'm going to take that screen off.
Okay.
And now you can press escape and come out of that. And then hopefully you'll see me.
I can't see yet. Okay, yeah, I can see.
So how does it feel to graduate from the Valuation Masterclass Boot Camp?
It feels great after 5 weeks intense hard work. Yeah, it feels great.
And how would you describe your transformation?
It has been really a lot more than what I expected. Like when I signed up, so it gave me like previously, like when I was valuing a company, I would start reading from first word to the last. Now I realize like which things to focus on, what to research, and what points are important to value a company, rather than just keep wasting time on things which don't really matter. So that's probably a big thing for me.
And why did you decide to join the Valuation Masterclass Boot Camp?
So just to enhance my skills. Even though I have like CFA level 2, but this is more practical. That's you're studying like your those valuation formulas and all that, but not actually doing it. This is like you're actually doing it just the way you equity research analyst would do at a job with a company. So that's what I thought, like that would be really good for me.
Was there ever a time during the boot camp that you felt like, oh, I'm going to get kicked out, or I can't make it, or I can't keep up? Like, what was the hardest part for you?
No, it wasn't really. I thought like at any point like I would get kicked out. But like in week fourth, I think it was fourth week when I felt a couple of days I got like ill, and then I started to feel getting behind, and that's when I got a little bit nervous. Like, but then by Sunday I had completed that week work as well, and yeah, it was all good.
Yeah. Yeah, well, it was great having you in. I appreciate the fact that you were always engaged in every session that we had, which makes it a lot more fun for the teacher.
Yeah, no, thank you to all the knowledge you shared, and I really enjoyed it.
Yeah, fantastic. All right, I'm going to take you out of this, and then and I'll see you in the Slack channel. But great job, and now you can relax.
Thank you.
Yeah. So how about that? That was an excellent presentation. Would you buy Target right now? Share prices come down a lot, as we saw, almost a 40% upside, 50% upside. Cheap on a PE price to book basis, but no catalyst right now, falling and falling and falling, but maybe that can change. And remember, it's when markets are uncertain about a stock is a time that there's an opportunity. Now, I just want to highlight, if you want to build a competitive advantage in company valuation, join us at the Valuation Masterclass Bootcamp. In fact, I think I've got some thing here I can show you. 1 second. So if you want to join, this is the best way to do it. Use this coupon code BC21Live at checkout, and you're going to get $900 discount. Now, this offer lasts for the next 7 days. So use the QR code or use that link, and I'll see you in the Valuation Masterclass Bootcamp.